This is Jessica Dunn, Finance 610, and today we're going to cover Chapter 8 in your Seedman text. We're going to talk about loan guarantee programs. There are three types of loan guarantee programs. The first and the most widely used is the SBA 7A program. This is by far the largest small business credit program. It's instituted by the federal government. The second would be state government guarantee programs. These are run by individual states to address specific problems within their state or to target specific areas. And finally is the Capital Access Program. This is a portfolio-based guarantee that is used to entice banks to expand their lending to small businesses. Loan guarantees are not used as often as direct financing, even though they have great potential to overcome market failures and to expand capital availability. The nice thing about loan guarantees is that it shifts the risk of extending credit from the lender to the third party that issues the guarantee. It provides an incentive for lenders to offer loans that they otherwise would not make because they're not having to bear 100% of the risk. The guarantor compensates the lender for any uncollected loan payments when the borrower fails to pay. Most guarantees are risk-sharing mechanisms where the lender would receive partial compensation for losses. They're not going to receive 100% of their losses. So because there are some funds at risk, the lender still has an incentive to be careful when they make the loan, to monitor these loans, to do good underwriting, and instead of just making loans willy-nilly, because they know that they're going to get all of their money invested back regardless of how well the loan performs. So here are the different types of guarantees. First is a market guarantee. This guarantees that there is going to be a specific level of sales. So if the market is uncertain, if we can't really estimate how much sales a company may have, they could receive a market guarantee, which would guarantee that they have a specific level of sales. This is often used whenever new products have been invented or new technologies that there's no historic market performance for. A price guarantee would be a guarantee that the purchase price or contract price would meet a minimum level if prices are volatile. This is often used in agriculture. So, when a farmer plants their crops, they don't know for certain what they're going to be selling for in the future. And so they could get a price guarantee to support and manage their crop production. A performance guarantee would guarantee a firm's successful completion of a contract, and this is often used in construction industries. A cost guarantee would cover any unexpected costs or any excess costs. So hazardous waste cleanup cost insurance would be a cost guarantee. A loan guarantee, which is primarily what we're going to be talking about, is a guarantee that a loan will be repaid, or at least a portion of a loan will be repaid. And this is really used for small business lending. A lease guarantee would guarantee lease payments to a landlord, and this would support an investment in a highly specialized building. So if a company needs to come in and needs to make a lot of modifications, they may obtain a lease guarantee so that way the landlord knows that they're going to receive at least some compensation for making the for putting in the expense of these specializations. So what happens when a borrower defaults? What cost would be borne by the lender? First off is the unpaid loan principal. So you as the lender, have loaned someone some money at a specific interest rate. That amount of money that you initially lent is the principal. So there is a chance that you may not receive the full amount that you lent them, the principal. If a borrower were to default, you also would not receive your interest, because whenever you lend them money, there's going to be a contractual interest rate associated with that, and so you're not receiving your interest payments. Additionally, there may be collection costs. So whenever you borrow money from a bank, they're going to want some collateral. They're going to give you a set amount of money. You are going to agree to make repayments of that on a timely schedule. You're going to pay them interest according to a contractual interest rate. And they're also going to want some sort of collateral. Usually, if it's your home, it's going to be, if it's a home mortgage, your home would be the collateral. But there is some cost to sell that collateral in the event that you do default. So those collection costs are another cost that's borne by the lender. Many loan guarantees can cover all three losses, but most, however, will limit payments for interest and collection costs. So most guarantees are going to guarantee primarily the loan principal. There may be some benefits for the interest and collection costs, but those are going to be minimal. However, loan guarantees can take any shape imaginable. So there are three types of loan guarantees that we'll cover. The first here, Guarantee A, is a first loss guarantee. So we have a $500,000 loan, a 60% guarantee percentage. This is a first loss guarantee. So now this borrower has defaulted, and they defaulted and still owed $200,000. So the first loss guarantee says that the guarantor will pay for losses from the first dollar of loss incurred until the maximum guarantee amount. The lender only incurs cost when the total loan exceeds the guarantee. So here for this example, we have a $500,000 loan. 60% of that loan is guaranteed. 60% of $500,000 is $300,000. So this guarantee will pay up to $300,000, and they start paying at the first dollar of loss. So this borrower has caused $200,000 in loss. They haven't made it to the $300,000 point, so the lender is going to get all of their money back. They're going to get the entire $200,000. The maximum here for loan guarantee A, let's see. Well, I lost the whole thing. So the maximum amount that Guarantee A the maximum amount that the bank could lose here is 60% times 500,000, so $300,000. I don't know why my pen's not working. Okay, for Guarantee B, this is a second loss guarantee. So here we have the exact same conditions. We have a $500,000 loan, 60% of which is guaranteed. This is a second loss guarantee. And the borrower has defaulted on $200,000 of the loan. The way a second loss guarantee works is it only pays for losses that exceed the non-guaranteed portion of the loan. So here, just like the first, $300,000 is guaranteed. They are only going to pay if the losses exceed $200,000, because $300,000 is guaranteed, so $500,000 less $300,000 is $200,000. So they're only going to pay once the lender has lost $200,000. And here, the borrower has defaulted on $200,000 exactly, so the guarantee is going to pay nothing. Guarantee C, this is the same loan amount. We have a $500,000 loan, 60% of which is guaranteed, so $300,000 loan, but this is a pro rata guarantee. This is a shared loss. So it shares the loss between the lender and the guarantor based on the guarantee percentage. So here, again, the borrower has defaulted on $200,000 of the loan. The guarantee is going to pay 60% of that. So 60% of $200,000 is $120,000. So the guarantee is actually going to pay $120,000. So you see the differences here. The first guarantee, the first loss guarantee, pays from the first dollar of loss until they hit the maximum amount. The second loss guarantee doesn't pay until you've hit your maximum amount of loss. So here they would pay if you lost more than $200,000. And guarantee C, the pro rata guarantee, is splitting the loss. So from the very first dollar of loss, they would pay, the guarantee would pay 60% of that. So if the entire $500,000 loan was lost, they would receive $300,000. So the advantages and disadvantages of a loan guarantee. The primary advantage of a loan guarantee is that it has increased capital availability, because in all likelihood, the majority of your loans are not going to fail, and they aren't going to fail 100%. So you don't have to have your full guarantee money in a bank account somewhere, because you're assuming that a large portion of your guarantees are never going to be drawn upon. And those that are drawn upon are not going to be paid 100%. Because usually, if the lender has done their due diligence and have used the appropriate techniques for underwriting, then they have also made sure that this borrower is creditworthy. And so you're lending to someone who is creditworthy, who does have a good business plan and a good idea. So in all likelihood, they're going to do at least partially well. They're not going to lose 100%. So because you don't have to have that full amount of money sitting in the bank, you can get more done with a smaller amount of money than you would if it was direct lending. So if you were direct lending, you would have to have that full amount of money for every single loan. But here, you don't have to have all of that, so you're able to get more done with less money, because you're using a bank as a third party to come in and use your loan guarantee. So they're using their money for it. So another advantage is that it can function on a more efficient wholesale level, so it can delegate negotiations to the lender. You simply say, yes, I'm willing to guarantee this, and then you put the burden of, let's say, proof on the bank. So they're the ones that's going to have to do their due diligence. They're going to have to go in and make sure that this person is creditworthy, that they're willing to put their money on the line as well. They're not being exposed to the full amount of risk because you have guaranteed a percentage of it, but they do have some money on the line. So it relieves some of the technical time and some of the looking at financial statements and administrative roles. It pushes some of those costs over onto the bank or onto the lender. It may not be a bank. Another advantage is that it requires interaction between borrowers and private lenders, so it is helping to establish a banking relationship. Again, you as the guarantor, you're not actually putting any money on the table until there is a loss. So they are having to work with banks or with lenders. Another advantage is that it increases capital availability with lower capital funding than direct loan programs. Capital is only spent when losses occur. So this goes hand in hand with the first advantage that I talked about. You're not actually putting any money on the table unless there is a loss. So you can make a whole lot of guarantees with a small pool of money. Disadvantages. First, it's more complex to implement than a direct loan program because there are three parties that have to agree to the terms. The borrower, the lender, and the guarantor. All three of you have to agree to the terms, and so it's just more complicated. Second, it requires legal arrangements among all three parties. Again, it's more complex. Third, your guarantee is dependent upon lender acceptance. So you may guarantee a business loan, but they may not be able to find a lender that's willing to lend to them anyway, even though the lender wouldn't be exposed to the full amount of risk of the project. The guarantor must have sufficient financial strength to be accepted by lenders. So it may be difficult to start a loan guarantee program because you do have to be believable. A bank is going to want an individual or a group with substantial financial strength to guarantee a loan. It takes a lot of cash on hand, a lot of credit worthiness to be a believable guarantor. It also creates incentive to use debt, and it may cause the borrower to borrow more than what is necessary. So how do you value and price a loan guarantee? If you use sound pricing, it will reduce the potential for capital substitution and provides incentives for lenders to exercise care when they're underwriting and monitoring loans. So if you price these correctly, if you value them correctly, then there will be an incentive for the bank to do their job, to use good underwriting techniques to make sure that the person is creditworthy, and to correctly monitor the loans and to step in as soon as there is a problem. So the first option would be to use historical loss data from comparable programs. You could set guarantee fees and an amount to cover expected cost. The problem with this, however, is that there is a limited availability of historic loss data to draw from. Second would be Black-Scholes methodology. You could value this as an option. And third, you could look at the difference between a risk-free bond and a risky bond and use the percentage of cash recovered from a defaulted bond. The SBA 7A program is the most widely used guarantee program. It's by the federal government. It guarantees loans up to $5 million. Interest rates on loans with a 7A guarantee are negotiated between the lender and the borrower. For working capital, the maturity is up to 10 years, and for fixed assets, the maximum maturity is 25 years. So these loans are made with longer terms and lower equity requirements, so that allows a startup to get started and encourages minority-owned businesses. If the loan principal is less than $150,000, the maximum loan guarantee that you can receive from the SBA 7A program is 85%. So they're willing to guarantee 85% of the loan. If the loan is greater than $150,000, they will only guarantee 75% of the loan. And here is a website. It's coming. Okay, so here is the SBA's website. And here is where they talk about their SBA 7A program. So they're making loan guarantees. So they guarantee a portion of the loan to be repaid. And they work with a lending partner, usually a bank. And the lending partner actually makes the loan to you. The SBA is never out any money unless you, as the borrower, default on the loan. If you default on the loan, they will pay the bank or the lender a specific amount of money that is set by the loan guarantee percentage. And so the SBA 7A program, they have some benefits. They do offer competitive terms. These interest rates that you would receive from the bank are going to be lower than they would if you did not have the guarantee because you're exposing the bank to less risk. In addition to this, you have counseling and education provided to you by the SBA. And sometimes you're able to have a lower down payment and flexible repayments. And sometimes you don't have to have any collateral. All of this would be unique to each loan. They have expanded the amount of loan availability. You can now get up to $5.5 million for your business instead of $5 million. So you can get it to finance your working capital or your fixed assets. Here are the requirements. You must be registered as a business. You must do business in the United States. You must have invested some of your own cash. You must have equity in the business. And you must have exhausted your other financing options. So you cannot get funds from any other financial lender. There are state guarantee programs. These aren't as prevalent as the SBA. One of the main reasons why they're not as prevalent is because it's sometimes difficult to start a loan guarantee program because, again, you have to be substantial for a bank to believe you as the guarantor. You're going to have a large pool of money, and you're going to have to be creditworthy. But here are some examples of some state programs. For example, Alaska. They have a maximum guarantee of $1 million, and they guarantee 80% of the loan. California offers working capital, equipment, leasehold improvements. They guarantee up to $350,000, and their guarantee is for 90%. And they continue, and the states are able to define who gets their loans in a very clear pattern. So not all of these are directed towards the same types of people or types of businesses. For example, if you look at Indiana, Indiana has a high growth technology firm requirement. So you have to be involved in a high growth technology industry to be able to receive their loan guarantee. So states are more likely than local governments or nonprofit entities to establish a guarantee program because states have a lot more credit strength and they have a larger reserve, and all of this is needed to be a credible guarantor. So it's much more difficult for a nonprofit or a local government to establish a loan guarantee program than a state. Capital access programs are very interesting. They use a portfolio-based guarantee rather than guaranteeing individual loans. So 20 states and 2 cities have capital access programs. They're very simple in an administrative role, and they have lots of flexibility. So the way that they work is a bank would establish a loan loss reserve for all loans under the Capital Access Program. So if they fall into a specific category, then there's a loan loss reserve for them. The borrower pays a fee which is matched by the local Capital Access Program. This fee that is matched is deposited into the loan loss reserve at the bank to cover losses on the bank's Capital Access Program loans. No additional guarantee is provided. So if you're eligible, if you meet specific requirements to be in the Capital Access Program, then you would pay a fee. That fee would be matched by the Capital Access Program. It would be given to the bank, which would be put into a loan loss reserve to cover any loss associated with any loan in that program. So this allows participating banks to make all credit decisions. The decisions are not having to be reviewed by the state or local program. They decide which loans fit into the program. Banks usually complete an application to participate in the program. Then they file a simple form for each new CAP loan to receive the matching fee. Borrowers are only having to deal with the lender. They are not having to file additional paperwork, and they are not having to apply to a separate program. These simple procedures make the program easy for states and local governments to administer. The program can be adapted to fit unique goals or market conditions. Some states increase the state match for Capital Access Program loans to minority or women-owned firms or to firms located in distressed areas. So this would provide an incentive for banks to expand lending to these targeted borrowers. So you can create your program in any way that you want, and you can encourage lending to the specific areas that you're choosing, minorities, women-owned, businesses in distressed communities, by providing a higher match fee. So when the borrower pays their fee, you could pay greater than their fee. You could match it at a higher percentage to encourage the bank to go with these types of loans. Illinois, Indiana, and Pennsylvania have increased their matching fees for minority-owned firms. This is encouraging banks to make loans to minority-owned firms because they are receiving a greater amount of cash for their loan loss reserve. Banks decide how to best use additional loan loss risk protection provided by the Loan Loss Reserve Program. So there are different policy levers. First, a targeting policy. This would define the type of firms and projects that are eligible to receive a guarantee. So these can fit economic development goals, gaps in capital, or program size. They need to target individuals not adequately served by other programs. Firms not served by the 7A are small loans, firms with specialized collateral, firms in emerging or especially risky industries, and real estate projects in weak market areas. Second, financing policies. These define the guarantee terms and lender risks covered. They should be tailored to the level of financial risk that lenders face. Fees should reflect the level of risk. Third, how is the guarantee secured? What mechanism reassures lenders that the guarantor will meet obligations? There are three ways that you can reassure that the guarantor will meet their obligations. First would be a general obligation pledge. This would just be a promise based on the guarantor's financial strength. Second would be a cash reserve. So there would be a dedicated cash account established at the bank, and they would make payments to that to guarantee the loan. Third, direct cash collateral. Again, money just deposited with the bank. Underwriting criteria. So what underwriting criteria would you use? You can set the risk level that the guarantee will incur based on the financial characteristics of the guaranteed. And fifth, the process for underwriting, monitoring, and loss collection. How much power is delegated to the lender and how much power does the guarantor retain?